Welcome to NeuroProfit AI. Today is September 17th, 2025. You have worked hard to save your first $1,000. This is a significant milestone. It represents discipline, sacrifice, a desire for a better financial future. Now the question is, what to do with it? Leaving it in a standard checking account is like putting a talented runner on a treadmill that is turned off. The money is safe, but it is not going anywhere. Inflation. The slow, steady increase in prices, groceries, gas. Investing is putting your money to work to grow faster than inflation. Think of investing not as a risky gamble, but as planting a seed. Your initial $1,000 is that first seed. With care, time, the right conditions, that seed can grow into a strong tree. The tree produces seeds that grow into more trees, a forest of financial security. This concept is called compounding. Earning returns on your returns, exponential growth. Start in 2025, time is on your side. The earlier you start, the more your money can compound. Before you rush to invest your $1,000, it is vital to build a stable financial foundation. Investing is for long-term growth, but life happens in the short term. You need a safety net. The first and most important step is to create an emergency fund, a separate savings account holding 3 to 6 months of essential living expenses. Think of it as your personal financial firefighter. If you lose your job or face an unexpected medical bill, this fund helps you manage the crisis without selling investments or going into debt. Next on the checklist is tackling high-interest debt, credit cards, payday loans. These often carry interest rates of 20% or more. Paying off a credit card at 19.99% is like getting a guaranteed 19.99% return. No investment can promise that. Define your financial goals. Short-term, vacation in 2 years. Medium/long-term, down payment in 10 years. Long-term, retirement in 40 years. A budget is simply a plan for your money. Turn your one-time $1,000 into a habit. Invest $100 every month. In Canada, how you invest is just as important as what you invest in. The government offers two powerful tools: the tax-free savings account, or TFSA, and the registered retirement savings plan, or RRSP. It is crucial to understand that these are not investments themselves. They are special types of accounts that hold your investments, like GICs, ETFs, mutual funds. The primary benefit of these accounts is that they shelter your investments from taxes, allowing your money to compound and grow much faster than it would in a regular taxable account. Think of them as greenhouses for your money, protecting it from the taxman. The tax-free savings account, or TFSA, is often the best place for a new investor to start. The name is a bit misleading. It is much more than just a savings account. Any investment growth is completely tax-free. When you decide to withdraw your money, whether it is next year or in 30 years, you will not pay a single cent of tax on it. This makes it incredibly flexible. For your first $1,000, the TFSA is an excellent choice. When you contribute to an RRSP, you get an immediate tax deduction. For those who are brand new to investing and perhaps nervous about risk, there are two excellent super safe options: high-interest savings account, HISA, guaranteed investment certificate, GIC, perfect for an emergency fund, ideal for very short-term savings goals. When you can't afford to lose any capital, they won't provide high stock market growth, but they offer peace of mind. What is a HISA? Often offered by online-only banks or credit unions, it pays much higher interest than the standard 0.05%. In 2025, HISAs often pay around 3 to 5%. Example: put $1,000 into a HISA at 4%, you'd have $1,040 after 1 year, risk-free. What is a GIC? Buying a GIC means you're lending your money to a financial institution for a fixed period, known as the term. For example, a 1-year GIC of $1,000 at 5% pays you $1,050 at the end of the year. The trade-off is less flexibility. Your money is typically locked in for the term. If the institution is a member of the Canada Deposit Insurance Corporation, CDIC, your deposits are protected up to $100,000 if the institution fails. For a beginner, using a HISA or a GIC inside a TFSA is a fantastic first move. It's a confident first step on the path to becoming an investor. Once you're ready to take a step beyond guaranteed returns and enter the stock market, a robo-advisor is one of the best and easiest ways to do it. A robo-advisor is an online investment management service that uses algorithms to build and manage a diversified portfolio for you. No actual robots involved. Don't be intimidated. It's a simple, automated, low-cost way to get a professionally managed portfolio. You start by answering a short online questionnaire about your financial goals, your timeline for investing, your comfort level with risk. Based on your answers, the service automatically invests your money in a suitable mix. It takes all the guesswork out of investing. You don't need to research individual stocks or build a balanced portfolio yourself. The robo-advisor does the heavy lifting. They typically invest in low-cost ETFs, spreading your $1,000 across thousands of different companies and bonds from around the world. Example, deposit $1,000 into a TFSA with a robo-advisor. It builds a balanced portfolio, 60%, $600, stock ETFs, 40%, $400, bond ETFs. The service automatically manages the portfolio, rebalancing when needed. This disciplined, automated approach removes emotion from investing. Typical management fee ~0.5% per year. On $1,000, that's about $5 for the year. For beginners wanting a set-it-and-forget-it approach, a robo-advisor is a modern, accessible choice. If you are a bit more of a do-it-yourself type and want to be more hands-on than with a robo-advisor, exchange-traded funds, ETFs, are your best friend. An ETF is a type of investment fund that holds a large collection of assets such as stocks or bonds but trades on an exchange just like a single stock. Think of it as buying a basket of groceries instead of buying each item individually. With one purchase, you can own a small piece of hundreds or even thousands of different companies. For a beginner starting with $1,000, all-in-one asset allocation ETFs are a revolutionary product. They hold a mix of stocks and bonds from Canada, the US, and around the world. Vanguard, VGRO and VBAL, iShares, XGRO and XBAL, BMO, ZGRO and ZBL. GRO typically signifies a growth portfolio with about 80% stocks and 20% bonds. BL signifies a balanced portfolio with about 60% stocks and 40% bonds. You could use your $1,000 to buy shares of an all-in-one balanced ETF, like VBAL, the Vanguard Balanced ETF portfolio. If VBAL is trading at $25 per share, your $1,000 would buy you 40 shares. Instantly, your money is invested in over 20,000 different stocks and bonds from across the globe. You now own a tiny fraction of Apple, Microsoft, Royal Bank of Canada, Shopify, all through a single transaction. The management fees for these ETFs are incredibly low, often around 0.25% per year. On your $1,000, that is just $2.50 annually. The key advantage over using a robo-advisor is that you cut out the middleman's fee, requiring only the ETF's own low fee. Now that you understand the types of accounts, like a TFSA, and the types of investments, robo-advisors, ETFs, it is time to take action. The process is almost entirely online and can take less than 30 minutes. Choose where to open your account. Robo-advisor platform, Wealthsimple Quest Wealth Portfolios, or a self-directed online brokerage. Big banks, RBC, TD, BMO, Independence, Questrade, Wealthsimple Trade. If you choose a robo-advisor, the process is straightforward. Go to their website, click Get Started, and begin the sign-up process. You will need to provide your personal information, your name, address, date of birth, and social insurance number for tax purposes. You will then answer the risk tolerance questionnaire we discussed earlier. Finally, connect your bank account to transfer your initial $1,000. If you decide to build your own portfolio with an all-in-one ETF, you will need a self-directed investing account. Many beginners in Canada gravitate towards Wealthsimple Trade or Questrade because they offer commission-free purchasing of ETFs. Once your account is open and you've transferred your $1,000, ideally in a TFSA account, you are ready to make your first purchase. Log into your brokerage account, use the search bar to look up the ticker symbol, for example, VBAL or XEQT. Place a buy order. You will be asked how many shares you want to buy. The platform will show the current price per share. You can choose to invest your full $1,000, and the platform will calculate how many full shares you can afford. Click confirm, and within moments the trade will be executed. Congratulations, you have just used modern technology to become a diversified global investor from the comfort of your own home. Investing in the stock market involves a trade-off between risk and reward. It's important to understand this relationship in simple terms. The reward is the potential for your investment to grow over time. The risk is the possibility your investment could temporarily lose value or, in rare cases, permanently lose value. Generally, higher rewards like stocks come with higher short-term risk. Safer investments like GICs offer lower rewards but very little risk. Your job is not to avoid risk entirely but to manage it to match your goals and comfort. Market volatility is normal. The market does not go up in a straight line. It zigzags with periods of strong growth called bull markets and periods of decline known as bear markets. When the news screams market crash, it can be frightening to see $1,000 drop to $900 or $850. Remember, you haven't lost money unless you sell at that price. History shows markets recover and reach new highs. Patience and discipline are your greatest assets. Diversification through ETFs and robo-advisors protects you from a single company's failure. If one company in your ETF goes bankrupt, it has a minuscule impact on your portfolio. Bonds act as a stabilizer. High-quality government bonds often hold value or rise when stocks fall. A balanced portfolio, 60% stocks, 40% bonds, is much less volatile than 100% stocks. Understanding this helps you stay the course. The risk is the bumpy ride. The reward is long-term growth that outpaces GICs or savings accounts. We have covered a lot of ground from preparing your finances to choosing your first investment. It might seem like a lot of information, but it all boils down to one simple, powerful idea. You need to start. The journey to building wealth is not a sprint, it is a marathon. And like any marathon, it begins with a single step. Your $1,000 is that first step. It is the most important one you will take because it overcomes the inertia and fear that keeps so many people on the financial sidelines. Do not fall into the trap of waiting for the perfect time to invest, or waiting until you have enough money. The perfect time is now, and $1,000 is more than enough. Think about the power of habit. Your goal should be to turn investing into a regular automatic habit, just like paying your phone bill. Once your account is open, set up an automatic contribution. It could be $100 a month, or even just $25 a week. This strategy, known as dollar cost averaging, is incredibly powerful. You automatically buy more shares when prices are low and fewer shares when prices are high. It takes emotion out of the equation and builds your wealth steadily over time. That small, consistent contribution will be the engine of your long-term growth. Let this sink in. If you invest your initial $1,000 today and add just $100 per month, assuming a conservative 6% average annual return, in 30 years, you could have over $100,000. This is the magic of compounding in action. It is the result of your discipline, your patience, and your decision to start today. Wealth is not built overnight from one brilliant investment. It is built over decades from thousands of boring, consistent ones. Your future self will thank you profoundly for the small sacrifices you make today. So, take a deep breath and commit to taking action this week. Choose your path: the safety of a GIC, the simplicity of a robo-advisor, or the control of an all-in-one ETF. Open the account. Transfer the funds. Make your first investment. You are no longer just a spender. You are no longer just a saver. You are an owner. You are a participant in the growth of the global economy. Your first $1,000 is not the end of your savings journey. It is the beginning of your wealth-building adventure. Start today.